Good afternoon and good morning to our West Coast participants. Thank you for joining today's ICD webinar, Private Company Incentive Plan Design Part 2. My name is Scott Munn. I'm a partner with Hugessen, and I'll be moderating today's session along with George Soiree. Some logistics. The webinar will run for about an hour. Please send us your questions as we're going throughout the webinar. We'll endeavor to answer them as we go along or during the Q&A session. For the folks listening in, you're on listen-only mode. We are recording the webinar, and the presentation slides will advance automatically. As well, they'll be available for download both now and later today on the ICD website. If you need any technical assistance, please refer to the chat feature on the screen, or if not available, please call Kim Carthy at 416-593-7741, extension 289. Let's take a look at the agenda. For those that listened in last year, in October of 2018, we hosted a webinar with the ICD related to governance and compensation for private companies. Today's webinar addresses similar information, but it provides a double click on long-term incentives. So specifically, we're going to spend some time reviewing briefly pay philosophy, principles, short-term incentive plan designs, all the background information, and then spend the majority of the webinar, probably 40 minutes, on long-term incentive design for private companies. Let me introduce our panel. We're joined today by Mike Colbert and Ethel Taylor. They're both accomplished directors. Mike's held a number of executive roles in the energy sector in Canada with Petronas Canada, Pacific Northwest LNG, and Callan Home Oil. Ethel was, in addition to what's shown here, previously chair of Aspera Cooper Board. She's a former member of the Trillium Health Foundation and retail boards, and she has past executive roles with Black's Photo and Sears Canada. In Toronto is my colleague George Soiree. He's one of our founding partners at Hugessen and has been my colleague on these webinars for the last number of years. For those folks listening in, Hugessen advises boards on executive pay, corporate performance, and related governance. We work with over 150 clients, and we're very active in supporting the ICD and helping to deliver the DEP program, both in Calgary and Toronto, but across Canada. Just to round out the team for today's webinar, we're joined by Laurie Brotherton and Salam Tessagay from the ICD, as well as our colleagues Michael Ray and Matt Downey from Hugessen. So, past the basic intros, just a quick comment on tax and accounting. We're going to touch on tax accounting and securities issues related to compensation, but frankly, a detailed review is beyond the scope of the webinar. So, to the extent that folks listening in have specific questions or issues, we suggest that you seek independent legal and tax advice. With that intro, let's get started. The majority of the slides on the first three sessions are from last year's presentation. We're going to go over these, as I said earlier, fairly quickly, and then we'll dive into greater detail on the LTIP. If you want to see last year's information, you can listen to the webcast and the webinar, and look at the ICD website, and all the information's there from October 2018. So let's start with good governance principles for the board. Really typical practices, of course, include having a qualified and engaged board with directors who have experience, skill sets, and times to carry out their responsibilities. There's specific mandates for the board and the committee, and they should be clearly articulated. We usually see board and management agreeing upon a good framework for how information will be prepared and presented by management to the board to allow for effective decision-making. There's some basic protocols about how major decisions are made. There's in-camera sessions. There's usually good communication between the board and CEO, especially around sensitive matters associated with exec comp and governance. I apologize for moving quickly through this, but looking at the organization types, we usually see a well-laid-out pay philosophy. Invariably, there's going to be the need for some judgment around where the organization fits within this spectrum, who it sees as peers, and how you start to think about executive pay and design. I know, Mike, you and I have had discussions about some of your past boards. A couple of initial comments?
Yeah, thanks, Scott. Just to set the stage regarding my experience, listeners a bit of knowledge of my background in regards to private and public company boards and compensation committees in particular. Reserve Royalty Income Trust resides on the left-hand side of the organizational chart here as a small private enterprise. Petronas resides solidly on the right-hand side of the slide with over 50,000 employees worldwide and 300 plus employees with Petronas Canada. Interestingly enough, my experience comes from the trenches, and when Petronas acquired Progress Energy, which was a publicly traded company in 2012, in advance of the closing of the acquisition, as CEO, I worked along with my CFO and HR group and the Petronas group in Malaysia to really get in front and establish a Made in Canada compensation plan that fit within the Petronas worldwide compensation practices and their philosophy. We had the challenge of replacing a public company program that would be competitive and would achieve high retention rates. And with that, the new program ultimately had some real successes and some pitfalls along the way. As I say, Reserve Royalty is on the small end of the food chain, and we were challenged on an ongoing basis with the affordability plans and that type of thing. I also have the pleasure of being on the two public compensation committees. I chair the Interplus committee, and then Precision Drilling is also a committee that I'm on, and both of those companies have cross-border challenges in Canada and the U.S.
Thanks, Mike. Let's take a look at some factors that boards will want to consider. The first one is going to be identifying pay peers and data sources. In our experience, this can be challenging. Data is often imperfect, and coming up with peers may be difficult, especially if you run a fairly unique private company. As a result, compensation becomes a bit of a triangulation exercise. You have to look at multiple data points. A common question that comes up is whether or not there's any discount for compensation for roles in private organizations. This comes up because the regulatory, governance, shareholder, investor-related activities or responsibilities may be less. And in our experience, this can be fairly firm-dependent, fairly role-specific. And it's usually a typical discussion around the CEO and CFO roles. The degree to which it gets applied depends significantly on the organization. In our experience, pay for performance is the focus, with shareholders really wondering what level of performance is appropriate and then trying to figure out how to compensate the executive team for it. Ethel, I thought you may have some context here given your boards, so I'll pass it over to you.
Thanks very much, Scott. I've had experience both in small enterprise and currently in mid to large private enterprise. There are really, in both of those instances, completely different philosophies in terms of managing a company owned by a PE-controlled business and the portfolio of companies. It really had a different incentive than we have currently at CAA, which is a very tailored philosophy for a member-owned enterprise. I think, at least from my experience, the opportunity to work through all of the challenges, and just as you said, Scott, it's hard to find something that's identical in a private company, but certainly we were able to do that for CAA, and it's made a tremendous difference in how we can focus our organization.
Thanks, Ethel. The building block to a successful incentive program has to start with an acknowledgement of the company strategy. And if you're a private enterprise, whether it's a private company owned by a family or by a corporation or a crown corp for that matter, and you're embarking on an exercise to design an incentive program or change an incentive program, the starting point really needs to be a look at that enterprise's strategy, and hopefully there is an articulated strategy. And why? It's because at the end of the day, the incentive programs, whether it be the short and especially the long-term incentive programs, should be aligned with that strategy, and they should be there to support it. And importantly, you should be asking the question, well, what does success look like in the midterm and in the long term? And if, as management, you're talking to the board and you're having difficulty identifying, geez, what is success in the mid or the longer term, that's your first clue that maybe you're not ready for a long-term incentive program. But in fact, if those objectives are reasonably clear, then at least you've got the building blocks for, designing an incentive program. So actually, we're going to do some polling questions along the way, and we've reached our first one, and you'll see on your screens an opportunity to answer these questions, and we'll get a quick tally and give you the results as we go through the deck. So the first question is actually to get a sense from the audience of how robust the linkage is between the establishment of a strategy and the development of the incentives for senior management in that company. So is there strong alignment would be A. In other words, is both is there a strong discussion around strategy as well as how the incentives are supposed to support that strategy? B would be there's a modest degree of connectivity between those two. Or C, in fact, the strategic imperatives are not actually taken into account in the design of the PAVE program. So we'll let people click on those responses. So carrying on, best practices, again, before getting into the detailed mechanics of a short-term or a long-term plan, here are some suggestions we have for the audience on, many of these are focused on process. And if you can get most of these process-related features right, at least you've got a starting chance at designing a program that's going to work for you. If you actually fall down or cannot get these process things disciplined, you are highly likely to get yourself into hot water pretty fast. So what do we mean? First of all, there should be an understanding between the board and management of what's the appetite for complexity in the incentive program. And you got to get that philosophy nailed down. And if there's a gap, you got to sort that out before you embark on designing something. Secondly, there should be time allotted in the meetings and through the course of a year for designing a program and making informed decisions on the design or the fixing of an STIP or implementing a new LTIP. It takes energy, it takes a lot of time, and really the board especially has to get engaged with management to devote that time so that people understand what they're agreeing to when it comes time to actually officially approving an incentive program. Then there should be significant analysis done, backward testing, forward testing, stress testing, again, to better understand, hey, if this program had been in place, would it have worked the way we wanted it to? Or testing against, for example, your forward strategic plan. How will the program pay out if we achieve our plan? What happens if we miss it? What happens if we exceed? Those are the kinds of things that need to happen. Then finally, you've designed this beautiful program, you have to be able to engage with your employee base in an effective way, make sure people understand how the program works and how it's performing over time. So Mike, perhaps you can share some wisdom on how these principles have been put to work.
Yeah, sure, George. I can give you a little bit of an experience that I've had with Petronas Canada, and as I mentioned earlier, as we implemented the new plan into the private company going forward, as you say, setting the strategy, communicating, and ultimately establishing the goals was key to the entire compensation program and the rollout. So for Petronas Canada, we had a strong desire to have a compensation package as a whole that would compensate people competitively and have a very high level of retention, as I say, as we went from being acquired into the new entity. And the retention and ultimately the attraction of talents was extremely important because we had a company strategy to really build a leading natural gas development company and liquefied natural gas, and that would have us invest in the range of about $4 billion 2013 through 2016. So very aggressive capital investment program, and as I say, having those targets well established and measurable was key to the success of the company. So with that, we established the goals for the STIP and LTIP. We borrowed a lot of from our previous program that we did with the public company, refined those targets, and then ultimately they really did reflect the typical energy company performance targets, which related to HSE, production and reserve growth, operating and capital efficiencies. Those were predominantly utilized for the STIP. And then really on the stretch side of things, because we had such a large capital program, we really pushed hard on the stretch with only looking at having achievability of maybe 2 in 10 at best. For the LTIP, rather than utilizing TSR or relative TSR as a measure that many public companies used, in this case we used more project-specific targets for the PSU-related longer-term view. And then we added in some more subjective things such as First Nations consultation, government relations, and that type of thing, which did require ultimate discretion from the board as to exactly how those were seen as being successful. So the interesting thing is, as you say, from a communication perspective, we took a very aggressive communication line, and because we wanted these goals to be understood by everybody, we actually had one-on-one meetings where each supervisor laid out to the individuals what their new position was all about. And those meetings were attended by HR representatives that could follow up as well. We also had small group meetings with similar level positions that were held to discuss the program's targets and really foster an open discussion. And that was also very key to get people talking about things, and I think gave us a lot of feedback that things were actually going well and being communicated effectively.
Great, thank you, Mike. So actually, we can give you some results from that polling, the first polling question. Glad to see that at least 36% of the respondents thought that there was strong alignment, but I think we'd all acknowledge that that really should be a higher number, with 45% saying there's modest alignment and just under 20 saying there's weak alignment. So not shocking, but it is one of the preconditions for doing a successful design. So let's keep going here. Again, we're going to touch on short-term plans or STIPs, and we all know that you can have formulaic plans or you can have plans with much more discretion, and there's a whole continuum. Ethel, what are some of the principles in designing a good STIP that you've tried to put into practice?
We at CAA and in Running Blocks, we used our STIP as a basis for the goals throughout the organization. So although STIP at a more senior level may be weighted differently, the STIP as we move through the organization, for example, revenue at CAA, we have 4 channels that consolidate for the senior level management, but as we move closer to the front line, their accountability is maybe for online. And so all our goals, in all of our measures in STIP actually are able to move through the entire organization, which really cleans up a fragmented approach to what we expect or what we want to achieve. So we can start from the top down or the bottom up to create the STIP. And we did something similar to Mike. We meet with groups about every 3 years just to reinforce how their annual bonuses assist, or STIP assists the whole organization. So people have a sight line to, and we have a long tenure and a very low turnover in our organization, but they have a sight line to how they make a difference to the organization. That is a big opportunity, I believe, or we believe as an organization, for the entire company to be focused. And naturally, that speaks from those numbers come from our overall vision and mission and the principles in which we operate the organization and the growth agenda that we have. But one of the things that we're very proud of is that each of our associates would be able to give you a similar answer, not a similar payout, but a similar answer to senior leadership on their short-term incentives.
Right. So actually, if we look at the scorecard on the next slide, just a high-level illustration of a simple formulaic scorecard with some financial metrics and operating metrics. And if this was a corporate level approach, from what I've gathered, Ethel, you could have a derivative of this scorecard down in the divisions, all of it building up, but everybody being measured, for example, on revenue and cash flow or EBITDA, and trying to create, a common view of where that institution is headed.
Exactly.
So we've done a quick review in these last few slides. Now we're going to get into the meat of this webinar. I'm going to turn it back over to Scott to deal with LTIP, and also a reminder to folks to please submit questions online. We will gather those and try to address them. I see already a bunch coming in, which we really appreciate, so please keep that up. Over to you, Scott.
Great. Thanks, George. So let's talk a bit about LTIP prevalence and LTIP's role within compensation. We don't see a lot of market data about private company long-term incentives. In our experience, the bigger, more complicated ones are much more inclined to apply an LTIP. The smaller folks, it's really a question as to whether or not they wish to, and we're about to delve into all the issues associated with it. And as you'll see, there's many different choices from simple to complicated. So LTIP has some real and perceived complexities. Not all private companies employ one. There's a number of alternatives that you can look at, from cash-based to treasury-settled plans. And in our view, you can structure a program that mimics stock compensation, that can provide participants with real equity. It comes down to company-specific considerations, which is really what the next few slides is all about. So let's jump into them. Looking at the LTIP considerations, cost constraints, tax effectiveness, disclosure requirements all come to mind. And by disclosure, I'm not referring necessarily to the specific level of pay as much as the information sharing that you might need to provide to the plan participants around the financials of the private company that you may or may not wish to share. Obviously, they're intended to provide a better alignment with shareholders or other stakeholders, but there is a few things that you need to consider. One would be when or under what circumstances will a payout occur. Is it a liquidity event such as an IPO or the sale of a business, or is it going to be paid annually based on a calculated formula? Similarly, what is it that the shareholder is trying to achieve? And this goes back to George's slide about alignment and strategy. And the question often is, what's an appropriate risk-adjusted rate of return for the private company shareholder? And that will drive questions around corporate performance and the performance required under the LTIP. Valuation can be particularly complicated. You don't have a public stock to track, and so determining performance for both the participants and the owner can be difficult. And liquidity is also important. You run the risk that if the plan pays out in the normal course on a regular basis and not as a result of a monetizing event, that plan participants are getting a payout when the shareholder has not yet realized a gain. So lots to think about. Mike, I know you went through this before with some of your boards, so any of your thoughts here?
Yeah, I think the points on valuation and liquidity are extremely important. Reserve royalty, as I mentioned, is at the small end of the food chain, and we have real challenges with the LTIP program for a number of reasons. The valuation, liquidity, and ultimately even the dilution to shareholders is something we were very concerned with. So part of the question we always struggle with as well is that, how does the employee value the RSU that they will have to pay cash taxes on when it's exercised, and then ultimately, because of the liquidity, hold the stock for an undeterminable amount of time. Now, from time to time, we've looked at whether or not the company can afford to help with that tax burden by possibly having a cash component where they could take cash and stock. But the reality is, with a small company, it's very challenging to be able to do that. So. And then that also has accounting ramifications as you go forward with the reporting of that.
Ethel, anything you want to add here?
Well, we don't have the option in the CAA organization, as we're member-owned, to offer equity. What we've really focused on is ensuring that the strategy and we do it in 3-year increments, which I think is going to be discussed. It also creates a long-term engagement with our senior leadership team, and we do have a payout threshold, which I think is an important factor in terms of LTIP. It's been we introduced it in 2015. It's been a very positive, obviously, for the management group. We've had significant growth, and it has really led to, I believe it's assisted us go beyond the results that we had been experiencing in the past, and our growth has been substantial on all sides of our business. We also work. I just wanted to mention our methodology we review it. The HR committee reviews it, and the board votes on it every single year. So we review where we sit. We look at whether we should make any changes. Obviously, not in the terms of a 3-year term, but we continue to review it. So the board has a big input on the LTIP.
Thanks for that. Let's talk a bit about some of the LTIP objectives. There's traditional ones here, right? Attracting talent, alignment with shareholders, retention of individuals. In our experience, one of the challenges that the board's going to run up against is balancing the complexity of getting great alignment with the performance of the company and having something that's both straightforward and somewhat simple to communicate to plan participants, or providing the plan participants with a line of sight that they can influence. Equity is a very effective way of providing the executives with skin in the game, but it does become a question of how you balance that complexity versus accuracy. Of course, within the plans, there's common retention mechanisms, such as the deferral of compensation, the vesting provisions, the forfeiture provisions, et cetera, within the LTIP. Mike, you and I have had the chance to talk about the energy sector a bunch. Why don't you share that with some of these folks?
Yeah, as I said previously, I mean, the LTIPs for a private company, especially a small private company, are challenging. But in the energy sector, the LTIP is really required to be competitive. And with the demise of options, RSUs and PSUs seem to be really the only alternatives acceptable to shareholders and employees. I think the LTIPs do align employees and shareholders well, and when structured correctly in the right environment, it does provide them with skin in the game. And, with the strategic view of the company, having some level of liquidity in the near-term horizon is also very helpful.
Thanks. So let's talk briefly about the spectrum of LTIP vehicles. Boards can choose from a wide spectrum. There's all kinds of equity instruments that we're going to talk about. As you can appreciate, we'll be fairly brief here, but try to give a bit of an overview. In its simplest form, on the left-hand side of the slide that you're looking at, you can see that the deferral of an annual cash award over a 2 or 3 year period can be considered an LTIP. That can be made more complicated, more aligned, more exact, if you will, by thinking about ways of creating the amount to be deferred over a multi-year period. On the right-hand side, we have treasury-settled plans that are real shares. So these are restricted share units, performance share units, and stock options. You will want to come up with some approach to value the share, and that's one of the additional complications. In the middle, the gray area, are the unit or share denominated plans that are settled in cash. So a restricted share unit where the recipient at settlement receives a cash payout as opposed to a share from Treasury. Same with deferred share units and performance share units. And of course, phantom stock options are basically a cash payout of the in-the-money gain, and it's more commonly called the stock appreciation rate. A few things to keep in mind. We've talked a bit about the need to value the business. There are simple formulas For example, I've seen 3 times trailing 2-year average EBITDA. I've also seen more complicated approaches like the use of an independent third-party valuator. Whether or not the vesting is conditioned just on time or also performance, clearly the more performance goals you add to the plan, the more complicated it gets. And then how much to award. This is perhaps one of the bigger questions. You need to think through the granting framework, market norms, competitive practice, stress testing and affordability. And a key question that you may want to ask is, if you're going to pay this amount out in cash down the road, how much of that year's cash flow might the incentive plan use up? So, simple stress testing question. Let's move on to our second polling question. Please let us know how you would describe the long-term incentive program at your organization. You have 5 choices there. If you could take a moment to fill them in, that'd be super. And I will pass this back over to George.
All right, so now we're getting serious about putting in place an LTIP, and we're going to try to answer the question, why are all these LTIPs really 3 years? And a bunch on the phone may know the answer, but for those who don't, it all has to do with tax. And there are salary deferral rules, and these are things that you have to keep in mind. If you're going to embark on implementing an LTIP, you need to understand these rules. And in essence, so long as you have a deferral of compensation through some kind of LTIP, and it's no more than 3 years, keeping it simple, CRA is going to be fine with taking its share of the tax on that when the thing pays out 3 years later. However, if you get that wrong and you design a program that's longer and it doesn't meet some other conditions, it will trip the salary deferral rules, and you'll get a very bad outcome where, let's say it's a 4-year plan or a 5-year plan, CRA will say, that's nice, we want to collect our taxes on the date of grant, and you end up with a horrible situation where taxes are being paid by the employee, but 4 years before they actually get a payment, which may or may not happen. So be careful, but that's one thing you got to cover off. Next, Scott mentioned a few seconds ago that if you're going to embark on an LTIP and you want to tie it to the equity value of a private enterprise, by definition, you're into a challenge figuring out, well, how do you determine equity value when you don't have a market to look at? And so companies figure out in 3 basic ways in our experience. One is you can agree up front on a simple formula that you apply on the way in and you apply on the way out the same. That's a way to do it. Some have more complicated formulas like a discounted cash flow to measure the value at a given time. And yet others might say, no, we actually want a third party to come in, a professional valuator to come in and do a formal valuation, and that's what we're going to use to price the equity at the date of grant and also at the date of buying it back or creating liquidity. So, Mike, I know you've had some experience here. Maybe you can share how you've seen it work in practice.
Sure, George. Yeah, for reserve royalty, what we do is we've got 2 to 3 valuation methodologies that we utilize, and those would include any gray market trades, then, as you say, sort of taking a net present value of the organization, and then looking at peer groups as well, just to see if there's publicly traded peer members and what they're trading at based on multiples. So we take those factors and put them into our evaluation and really determine whether that could be defensible for CRA reasons. And that way, when the grants of the people taking the grants, that's the valuation we use. That's the valuation they pay taxes on, and ultimately, I think there's a lot of take-up that if the CRA accepts it, the employees accept it as a reasonable way to value the company. For Petronas, we're fortunate that the company is large enough to be able to establish publicly traded peer groups, and so with that, what we have is we call it the market factor, and so we set our grants, and then we set a group of peers that are publicly traded, and then we monitor that over the 3-year period in our case, and any new grants may have, the same peer group or slightly different, just like any use of a peer group. But the nice thing about that is that it's very transparent. Employees can get their spreadsheets out, follow along day to day, month to month, and really have that transparency as to what's happening. in the market that we're in, the business that we're in, but it also gives, I think, comfort to the shareholders that the valuation is reflective of what's going on in the larger, broader market.
Great, thank you. Actually, now we can take up question number 2 that people responded to. So actually, no big surprise, almost half of the audience are in enterprises where there is no LTIP, but just over half acknowledge that there is some kind of LTIP, and of those, half use a multi-year cash plan, so not tied to equity. The other half have a combination of either real equity, which is actually a significant proportion of that remaining balance, and about half of that number use phantom equity, and a very small number use some kind of carried interest or other more complex plans. So we'll be talking about some of these in the next slide. So, in fact, on the very next slide here, we're going to talk about a relatively simple medium-term plan, maybe is a better word for it, where we call it a multi-year cash plan. This is one where you're saying to yourself, okay, we're not tying it to equity value of the firm. Instead, what we're going to tie the payout is to specific metrics over a 3-year period, and those metrics are hopefully tied to the strategic plan like we've discussed before. You have to calibrate what's the target level of performance to get the target payout, how might the payout be expanded for outperforming, and how might the payout be cut back if you miss by a little bit. Again, quite a common type of approach in a private enterprise. Ethel, what kind of experience have you had with this kind of plan?
As I mentioned, we put LTIP in 2015. This is the methodology that we use. It is linked to our strategy. It's based on membership. One thing that we do, the basis is membership, but certainly profitability, membership satisfaction, which is a little unusual, but and profitability across the chain. The other element is that we have a number of businesses across all of our businesses. We have a number of businesses, but the base of the business is membership. So we have a large incentive for membership and the utilization of insurance, for example. So we have been able to move that needle substantially. We meet with management, all of the management team, for 2 days, usually in August, as we're preparing for the following year's budget. We also look at long-term incentive, and we look at the 3-year rolling plan where we're sitting, what elements of action we have to take to be able to meet what our objectives were and to adjust it if it's required. Then it comes back to us in a plan from management, but in terms of the incentive, we work very closely with the HR committee, and then it comes back as a recommendation to the board prior to the year beginning, but also reinforcing the focus that we have for the 3-year long-term incentive.
Got it, thank you. So now we're going to get a little more complicated and dealing with companies that, let's say, decide they do want to have, in fact, some LTIP tied to equity, but then they have to figure out, all right, are we going to use real equity from Treasury, or are we going to use notional equity? And usually the difference between those two, you have to go through this checklist of factors that we put on this page. And the biggest one in our experience that really make a difference is, first of all, is there a philosophy around the owners and the board wanting employees to feel and act like owners? And if there's a leaning towards that, then there'll be an appetite to use real shares. Also, there has to be an appetite around governance. You need to have a shareholders agreement. You need to have provisions in that shareholders agreement that's going to deal with buyout of the shares, exit events, who's going to buy the shares, et cetera. And you have to have, again, the appetite for complexity. Mike, what's been your experience with this struggle between using real or notional equity in private enterprises?
Well, I think the short answer is there doesn't seem to be any one set path. My experience really is that with the 2 private companies that I'm involved with, for Petronas Canada, the only option is to pay in cash, and then they use a phantom program and the market factor to make it look like equity. Reserve royalty, on the flip side, is can't afford cash, so their really only option is to have an equity share settled program. And then, interestingly enough, with one of the public companies that I'm on, it also, from the company's perspective, is treasury settled, but they sell the shares on behalf of all employees over a set period of time, and then give the employees cash settlement based on that average price. So, as I say, there's a really significant mixture, and it really comes down to the affordability and the I guess the desires of the plan as they go suit each company.
Well, let's get a sense from the audience, for those who do have equity-based plans, if you could just answer this question here, and we'll take it up in a few seconds. In our own experience, advising many kinds of companies, we tend to see that those who choose to use real equity are those that are, let's say, professional services firms or smaller, closely held enterprises, and certainly where there really is an ethos around ownership. People want to see employees being owners, and so they're willing to go through the pain, essentially, of having an equity-based plan, but it's not for everybody. We were asking a similar question right away, or a corollary, again, for those who do have an equity-based plan and you need to have a valuation approach, which one of these three methods do you have in your plans? If you could take a second to answer that. I'm going to turn now back to Scott.
Great. Thanks, George. So now we're going to delve into some of the tax and accounting considerations. And in our experience, the board and management are going to want to go through this list and think through, as well as all the other considerations, which plan might suit them the most. On the cash settled side, you see individuals are not taxed on the date of grant, but are taxed at the full income rates on the date of settlement. For the corporation, they usually get a deduction. The accounting cost actually varies on the fair value of the award between the grant date and the payout date. And that means that costs can actually be reversed if, for example, the notional share value declines during the course of the term. On the treasury settled side, the individuals are similarly taxed at regular income rates at the date of settlement. The corporation, however, has a fixed accounting cost and doesn't receive a corporate deduction, and those costs can't be reversed. So it's quite different than the cash settled approach. With respect to real stock options, the treatment is similar to the treasury settled plans, except individuals, of course, are taxed at a rate that's similar to the capital gains rates. Let's talk briefly about Canadian-controlled private corporations and getting real equity in a CCPC. I'm not going to delve into a lot of details. Frankly, I expect the folks listening in that either work for or serve on the board of a CCPC know those organizations. What it will say is that there's a fairly tight set of rules around what defines a CCPC. And we flag it here because these organizations do have a couple of extra tools available to them from an incentive design perspective for employees. And notably, there's a couple of tax benefits. One is the ability to use the lifetime capital gains exemption. And the second is the ability to get a preferential tax treatment on a grant of shares if those shares are held for more than 2 years. So those are sort of the main benefits of these types of plans. George, back to you to go through a couple of examples.
You bet. And actually, we do have the results of those survey questions. 3A, which was notional or treasury, it was 40% notional and 60% from treasury, so that's very interesting. And then 3B, which was having to do with simple formula, a vast majority, 50% use a simple formula. No surprise, only 10% use a complex formula. The rest, 40%, bring in third-party value. That's actually a pretty high percentage that use a third-party value, a third-party opinion. Okay, so now we're going to get a little bit more complicated, and for those who haven't seen equity plans before, don't be scared, but you do have to have the appetite to get into this kind of complexity if you want to put it inside a private company. So here on this page, we're dealing with not a plan that isn't using real shares. You don't need to use anything from Treasury, and we're in a high level describing a share appreciation rate, which really mimics, think of it as a stock option. In the simple illustration here, we're saying, well, if you value the company on the date of grant at $10 a share, and you give somebody 20,000 units, and you will have determined that's worth on the date of grant $50,000 worth of compensation value. There's a bit of science to that, but you'll have come to that view. So then 5-6 years go by, and these things will vest and pay out. And we just make an assumption. Let's say the thing has gone up from $10 to $16 in that time frame. It's a $6 value increase. Well, on 20,000 units, so the employee will earn a benefit of $120,000, and that will be taxed as regular income. That is how, in a very simplified way, a share appreciation rate would work. You have to be very careful with these kind of plans. You have to follow strict rules around how the vesting occurs and the time frames. But at least here, you can have something that is longer than 3 years. It can be 5 years, it can be 7 years, whatever you choose. That's a point of debate and what's practical. But this is an example of the kind of equity-like plan you can have in a private company without actually using real shares. If we go on to the next page, now we're going to get a tiny bit more complicated. Now, these are for companies where you do decide to use real shares. Here's one where we're using an example where it's a grant of, let's say, again, 20,000 units. But these are full shares, each at $10. And so it's a $200,000 targeted grant date value. And let's say, again, 4 or 5 years later, these things pay out. And there has to be an agreed mechanism for that. And it's either other shareholders agree to buy it out or a controlling shareholder agrees to buy it out. And again, you have to be very careful how that works. But there'll be full value plus a multiplier applied based on whatever the multiplier chosen in the plan. And so there's significant value payable to the employee in that case. And this is where details really matter. As long as these shares are being held for 2 years after vesting, then when they do get crystallized and get cashed out, this is where the full value of that value will be actually treated like a capital gain. And so again, the full value received by the employee is treated like a capital gain, so long as you meet the requirements having held the shares for 2 years. So if you go to that trouble and use real equity, you can see that there's massive advantage and great opportunity to deliver value to an employee that is not available if you just use a notional, non-equity based or non-treasury based plan. Again, Mike, your experience with treasury based?
Yeah, as you say, from a taxable perspective, it's definitely got its advantages. But as we've talked earlier, the liquidity is kind of the underlying issue here, making the valuation extremely challenging. You know, as a small company or family-owned company that is bringing outside talent in, you want to pay them competitively and get them invested in the company. Treasury-based plans are potentially your only option. If there's dividends, distributions, or profit sharing, you know, I think that enhances the experience over time. I've got a few friends with family businesses that their family members have decided not to continue in their footsteps and are not taking over the company. And ultimately, this can be a real issue as the new, call it professional management, comes in. How do they compensate effectively, and ultimately how do those individuals get liquidity, and especially if they leave in advance of some sort of a liquidity event. So, you know, it's a real challenge, but I think it's doable, and I think there's enough desire by folks to have skin in the game that they are willing to accept some of those challenges.
And Ethel, your experience with treasury-based equity in a private setting?
my experience has been with private equity firms. Usually the objective has been to prepare the company, then sell the company. Prevalent in that arrangement is a senior leadership team having a percentage of the sale of the business minus the original cost of the business. So no one... It is a phantom because no one knows exactly what the payout will be, but it has a lot of benefits in terms of the preparation of the company, the engagement of the associates, and then the timing comes at the close of the sale.
Strong alignment. So fantastic. We've actually, thankfully, we have some time for some questions. And Mike, I'm going to throw one back at you that's come from the audience. And let me just read it out for you. So in terms of best practices or your experience at Petronas, how much of the STIP and the LTIP development work was actually done by the board and by management?
Yeah, the majority of the work was completed by management, and in the case of Petronas, that was our experienced Canadian HR group as well as Canadian consultants, and then really with a validation and ultimately sign-off from Petronas's HR group in Kuala Lumpur as well. So the good news was that the compensation philosophy of Petronas was what we started building on, and it wasn't different enough that and not worldly enough that we couldn't fit the Canadian made for purpose within that. So, but definitely management did the majority of the heavy lifting, and then ultimately made it explainable for both employees, as I say, but ultimately the board for approval as well.
Thank you. One of the questions that's come in is when we deal with the shareholders agreement and using real equity, what are the most challenging features? And I may come back to you on that in a moment, Ethel. But what we can share is that the typical aspects of a shareholders agreement in a private company that have to get sorted out, it's actually the voting and control is typically not the problem, although sometimes family controlling shareholders fear that might be an issue. That's easily dealt with multiple voting shares and other governance. The tougher challenges are really all around how to deal with the buying and the selling of the shares when employees are leaving. And other than a private equity setting, where actually you don't have to talk about that too much because it's usually tied to a liquidity event. But other than that, you really actually do have to get agreement with everybody around how is liquidity going to be provided to exiting employees. And this is where, again, tax really matters. But what I can share simplistically is that the easiest answer to avoid very bad tax outcomes is that the selling shareholder is actually going to be selling his or her shares to another shareholder as opposed to back to the company, because if you're going to sell it back to the company, there's a high risk of very bad tax outcomes to the employee. So all these things have to get sorted out and reflected in the shareholders' agreement. I'm going to deal with another question. In terms of how deep equity would go in an organization, including in a private company, I'll open it either to Mike or Ethel in terms of if you're going to use equity for the senior team, how deep do you go below, let's say, the CEO direct reports? Anything to share there?
Maybe I'll just start. At Progress Energy, when we started the company in 2001, we really just had a dozen or so employees, and it was fair to say that the equity component went down to everybody in the company. And then as the company grew, I would say, and I don't know if there was a specific inflection point, but as the company grew, maybe past 100 employees, then there started being some differences as to how deeply in the organization that went. And so, and it would probably go down to the senior technical, senior financial level type people.
and George, in my experience, it has gone to direct reports of the CEO, and been fairly consistent in two different organizations with that, in my experience.
Right, and again, your range of answers here on this call is reflective of what happens out there. It is really an appetite between the board and the owners and the management, how deep you really want to go, and the appetite for complexity once again. One of the questions that came up had to do with, again, in a private setting, you're going to use let's say, equity or equity-like instrument. How do you deal with the valuation? And in the public market equivalent, there's a lot of volatility with the multiple swinging a lot and a lot of volatility relating to factors beyond control. But in a private setting, obviously that's not the case. How do you deal with that? Well, what we can say is, in a private setting, if you're going to use a multiple approach, for example, there's a decision made at the beginning that says we're not actually trying to reflect the real equity value. That's interesting but not critical. What we're trying to do is come up with a system that can be replicated consistently and fairly. So, for example, in one of our client situations, for the last 15 years, it's been a program that's been around for a long time, they adopted a formula that says 15 times the average of net income for the last 2 years will be the valuation approach to arrive at a notional equity value at the date of grant. And by the way, when the RSUs or the PSUs 3 years later have to pay out, guess what? You use that same 15 times trailing average net income. It doesn't matter what's happening in the market. That's irrelevant, but they've agreed that for that business, they're willing to do that. It keeps life simple, and it's a notional representation of value over time. One of the question had to do with sometimes you see a performance metric in a short-term plan, but it's also repeated in the long-term plan. It could be an earnings growth, or it could be a return on capital metric. So it's both in the STIP and the LTIP. Mike or Ethel, do you deal with that issue, or do you try to keep the metrics separate between the plans?
Go ahead, Ethel.
Okay, thanks, Mike. We've tried to keep the metrics separate in long-term incentive from our short-term.
Yeah, that would be my experience as well, as predominantly the metrics are kept separately. As I said, at one point we used some project-type specific targets in the LTIP, and those might have had a little bit of overlap, but in most cases they are separate.
And then, in fact, that's a reflection of what we typically see in the market as well. Somebody came back and asked a question. They wanted me to clarify. I referred earlier to, again, in a private setting, when you use real shares, if the shares end up being bought back by the company, it's a bad outcome. Just to be very clear, unless there's been some sophisticated planning, it's essentially double taxation, very punitive taxation in the hands of the employee, so to be avoided essentially at all cost, and there are solutions for it, but that's why I just wanted to provide that clarification. Let me just see here. There's a question here under 3-year cash settle plan. How do you set the metrics for the 3-year period? Are they typically based on best efforts or some kind of plan? I know there are all kinds of approaches to trying to set a 3-year goal, but again, I'd invite Mike or Ethel, how do you set realistic goals in a 3-year plan?
For LTIP, we do it when we're doing the strategic plan. We review it as we go forward, but each year. But the 3-year plan is determined with the board and management.
Yeah, I would echo that. I think it's really you're trying to take something that is built upon your short-term incentives and really then validate that over a longer period of time. And I think what we've also been cognizant of is that, one grant, 1 year, followed by subsequent grants, those may evolve, those targets may evolve over time as well. So we really don't have a fear of saying, well, we use this type of target, therefore we're stuck with it on all future grants. We let that evolve and change.
Great, thank you. Well, we've reached our witching hour. First off, I'd like to thank each of Mike and Ethel, your rich experience as executives and also as board members, and thank you for sharing those insights. The audience really benefits from that. And thank you to the team here at the ICD, Lori and Salam. We appreciate that, and the rest of the team at Hugessen. Again, great effort by everybody. As a reminder, you can download the slides from today's session immediately, and the full recording will be made available